In this episode, we're talking about how to invest in expensive markets.
So Grant, overvalued markets. Read a great blog post by an investor and advisor that we follow, Ben Carlson, also author of A Wealth of Common Sense. Great writer around markets, investing, and the behaviors that you need in order to be successful. He put out a blog post the other day around how to invest in overvalued markets. Right now, the price to earnings ratio, which is one of the valuation methods when looking at whether or not companies or markets are overvalued or undervalued, is sitting at about 30.1, which means for the S&P 500, on average, when you're buying into a company, you are paying $30.10 for $1 of earnings in that company. Historically speaking, the price to earnings ratio has sat around, this is a Shiller PE ratio, has sat around 16.8, meaning $16.80 you are paying for $1 of earnings. So a lot more reasonable price when investing in those markets.
Mm-hmm. Yeah.
Important to note that before we go any further, this is only one of the methods and indicators at looking at valuations. It should not be used solely on its own.
There's many things that our investment
it's the most popular,
yeah.
Thought we'd touch upon that briefly. So if we're seeing overvalued markets, Ben's article is great as it talked about some of the ways investors can invest while markets are overvalued, different options that they can use. So thought I'd ask you a little bit more about those options.
Yeah, no, this is a great topic, actually. It's very timely because this is actually something that we've been talking about with clients on a regular basis and questions that we've been seeing from our clients or prospective clients. And in fact, you and I sat in a meeting today with a client where we were, where that basically was the question: is like, where do we go from here? And so I think this is really topical. Ben put out a really great article, and we're going to touch along a lot of the same points in it. But I think there's really three common things that you can do in these situations. When markets are as expensive as they appear to be, and I say appear because frankly, what we're saying is that we don't know that the markets are going to crash down tomorrow. We're not making that prediction because we don't know that.
Nope. I mean, they could. Valuation is not a good indicator on timing markets. They could continue to go up for weeks, months, another year. We have no idea.
Yeah, because there's so many factors that play into where valuations are. Like, interest rates are still near historical lows, and with money being as cheap as it has been, that money had to go somewhere, which is gone to stocks and increased the valuations of stocks. Now that money is still really cheap, so it's not to say that money has to come out of the stock market tomorrow either. This could go for another 2 years, it could go for 5 years. We don't know. But the key thing is that we do know eventually things tend to go back to the averages. Things tend to come back to earth level, and so that's what we're preparing for, and that's what this is all about. So those three things. Well, the first thing that most people look to do, and this is the most common thing, this is the natural human behavior thing, would be to go to cash.
Completely safe.
Yeah, completely safe. I mean, your valuations, assuming that dollar will still be around, which is likely if you're in the Canadian dollar or the US dollar, it's going to be around probably. But that's a call, a pretty heavy call that you're going to make, and it really involves timing the market. Now, if you think we're at the peak, and you time the market that you're calling that peak, and then you're looking to eventually buy back in at a valley. That's what you're trying to do in those situations, or close to.
And there's no individual in the world who has consistently timed the markets.
No, it's. I mean, frankly, if you look at the best investors in the world, you look at the Warren Buffetts of the world, you look at Ontario Teachers Pension Plan, big endowment funds like Harvard and Yale. They don't try to do that, and there's a reason. I mean, with all their resources, if they could time the market, they would, but they can't, even with the resources they have. So I think that's a futile exercise personally, but that is what some people will try to do. The big issue I have with it is the opportunity cost that comes along with it, and most people don't factor that in. Again, I say, like, when I said that this market could carry on for another 5 years, it could. We don't know that it won't. And if you were to go to cash today, when interest rates are near all-time lows, your return on cash is next to nothing. In fact,
we know individuals who sat on the sidelines the past,
since '08. They've been just scared of the markets and have missed an incredible run, one of the best in history, frankly. And so the opportunity cost could be absolutely massive by doing something like that. So you have to be aware of that, because it's not just the fact that the loss of dollar value, but if you're missing out on 15, 20, 30% over the next few years of stock market returns, that's a cost to your portfolio as well, and you're never going to get that opportunity again. It's gone. So that's the real risk.
If you're going to go to cash, make sure you're willing to stick to it and follow through with and be okay with sitting on the sidelines.
Yeah, and giving up on potentially large portfolio gains.
What we would hate to see is you go to cash, watch things continue to go up, hear from your neighbor how much money they made in the past 2 years. You enter back in, markets humble you, crash. Now you've missed the gains and locked in some permanent losses.
Yeah, so. Exactly. I would say if you are going to look at that strategy, but I'm not necessarily suggesting that. I really wouldn't. But if you are going to go that strategy, right, pick a spot where you're going to enter back in and stick to that spot, and don't get dissuaded by anything else. So that's the number one. Number two is something probably more along the lines of what we would recommend for clients, which is diversification of the portfolio. And if you're coming from an all stock portfolio, like 100% stocks or 100% equity portfolio, one thing you can do to mitigate your risk or volatility is to start buying into other asset classes and getting away, moving some of your eggs to other baskets other than just the one primary basket, which would be stocks. So things you could buy, like bonds, for example. Bonds are a whole different animal. We could do an entire podcast on bonds alone. So there's lots of different kinds out there. Not all are good. Not all are bad.
Not all are as safe as investors believe.
Yeah, exactly. So you have to be careful there. But bonds, real estate, infrastructure like toll roads and power plants and bridges and things like that. Gold, currencies. There's lots of different asset classes out there. And so by diversifying your portfolio a little bit out into these other asset classes, you're going to mitigate the risk of just the stock market. Keep in mind, each one of those asset classes has their own set of risks associated to it. So you're trying to essentially you're swapping one risk for a different kind of risk, and in hopes that they don't both go bad at the same time, essentially. So that's one way of mitigating the risk on the just a pure stock market portfolio. And then the last thing you could do is, and it's probably not the most convenient option for people, but you can temper your expectations around what the future hold for you. So if the stock market does go bad, and you're holding a 100% stock portfolio, and by bad I mean we get a correction in the market, and your portfolio valuations drop, that could do a couple things. It could really set back your time frame as to when you wanted to draw the money out. So you could be prepared for that. Or it might mean that you need to put more money into the portfolio. So maybe you can save more, maybe you could work longer, those types of options. So again, I don't personally like that option, because that means you probably have to make a decision around doing something at a different time than you originally wanted to. That's not a position I'd ever want to put a client in personally. But that is an option for some people out there.
Depending on individuals' circumstances and their expectations, it may be the best option. We don't know.
Totally. It depends on the situation. And some people would be okay working a little bit longer. So, that's a personal decision. But those are really your three most common options you can go through. Go to cash, diversify your portfolio, or maybe change your expectations if we do go through a market crash in the next couple of years. Those are the things you can really do.
I think at the end of the day, like we mentioned, no one has consistently predicted market booms and busts. It's not something that we're about to start suggesting to do. It's about finding a strategy that fits within your portfolio. Yeah. And when you select that strategy, you need to stay disciplined to it. Yeah. You can't be switching back and forth, because that will only lead you to failure.
No, be disciplined, be consistent. That's the number one thing. Pick a strategy that fits your personality, and then just stick to it, and that's the best way you can approach it. That's what we do with our clients. We have our beliefs, but we basically manage that with our clients. So I think with that, why don't we close it off?
Yeah, for sure.
Be sure to check out our website, cgwfamilywealth.com. We post all of this stuff on there, including our articles, so check it out.
Yeah, we're going to be posting Ben Carlson's article in our description on the YouTube page, so check it out.
Yeah.
I'm also going to just post a brief information on Shiller PEs, just so for those who were hearing us talk about price to earnings ratios, Shiller PEs. You can take a look, take a read through, and find out a little more about what it's about.
So thanks very much. With that, let's close it off. Ready?
Aim, fire.